What are housing prices going to do in 2021? Is the housing bubble going to continue to boom, or is it going to bust and come crashing down like it did in 2008? I'm going to give you the information you need to determine the probabilities, and make sure you stay to the end of the video because I'm going to give you my opinion as to whether the real estate market will continue to go up or go way, way down. As always, I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over all the data I think everyone is missing. And it starts with this very simple formula. These are the main factors, in my opinion, that go into making the price of a house. So prices equal income plus rates plus supply and demand. And a lot of these factors go into the demand and possibly the supply, but I think these are the main components that make up prices in the real estate market. So understanding that, let's start by looking at where prices are adjusted for inflation right now. We go to the Case-Shiller Home Price Index. It goes back to 1999 because if we look at a chart, actually editor, go ahead and throw up that chart I always use of housing. We see that the prices in 1998 were almost the same as they were in 1900. So if we use 1999, 1998 as a starting point, it's basically like going back 100 years. It goes all the way to 2021 on the left, from 50 up to 200. This isn't the price of the house. This is just an index, so it just gives us a starting point of 100. So price is pretty flat, as we know, until the beginning of the 2000s, when the government and the Fed and a lot of other factors help us inflate this huge housing bubble. Comes all the way down, bottoms out in 2012. Very important, I'd like to point out, didn't bottom out for 6 years. More on that in step number 3. And gradually, it's gone up and up and up to the point where we are today, where it's the same level overall as it was in 2006. That's why I'm always confident in saying we're in a bubble, because if we were in a bubble in 2006, definitely in one 2021, because we're at the same levels. Now, if you look at this chart, this is just the overall US housing market. If you look at the individual markets, those high flyers were a lot higher in 2006 than they are today. So it's not exactly the same, but overall, the prices are just as high. And this green line is something we'll get into in just a moment. This is a representation of real wages. So that would be your wage adjusted for inflation. And I'd also like to point out this level at 100, where we started in 1998 or 99, is pretty much our baseline. That's the trend line going all the way back 100 years. So if we just take that line all the way across, it kind of bottomed out here in 2012. So any delta between where we are on our historic trend line and the prices, that's going to be the no bueno zone. In my opinion, that's going to mean that prices are expensive. Now, whether they're in a bubble or not, if they're just right here, that's debatable. But anything over this trend line, they're expensive. Anything below, they're definitely cheap. This chart is one of the main reasons I went almost all in with housing in 2012. I saw it coming down to its historic trend line, so I knew, or I thought, in my opinion, the risk reward was pretty good. Turned out to be a good bet. So now let's look at incomes. We go over here, and I really want to focus on jobless claims. This is a chart of continued jobless claims. We also have initial claims, and I kind of compressed the chart to point out the main pieces that I think are relevant to you making a decision as to whether or not the market's going to boom or bust. Starts at 2009, I kind of highlighted the 2010 timeframe, goes to 2020 and kind of stretches out because this is very important. The continued jobless claims peaked out just under 8 million during the GFC. We can see what they did during the cerveza sickness and how much worse it got than the GFC. I think in our minds, we think it was kind of like the same. It was just a financial crisis. No chance. This was, 3, 4, 5 times worse than it was during the GFC. Then the job numbers got I wouldn't call them better, but they got less worse. But they really start to flatten out and plateau at a level very close to where they were at the peak of the GFC in 2009, 2010. And if you zoom in on this chart, you see how the numbers are starting to flatten out. They're really not going down at a steep angle anymore. This would lead us to believe that we're going to have a big problem with jobless claims or unemployment for a long time to come. And then if we flip over to that initial jobless claims, we can see that the plateau, or where it starts to flatten out recently, is actually a lot higher than its worst point or its highest point during the GFC. So what does this chart tell us about income that we can use to predict future prices? It tells us that there's going to be downward pressure on real wages. Now let's move over to interest rates, more specifically mortgage rates. At the beginning of 2020, they started at 3.62. I believe that's the 30-year, because I'm getting this data from Fannie and Freddie's website. Can't remember which one, but it's either Fannie or Freddie or both. Editor, throw it up there so it looks like we know what we're talking about. At the end of 2020, in December, rates got down to 2.68% for a 30-year mortgage. That is absolutely mind-blowing. So rates have really gone down, mortgage rates. Now, those of you who are really paying attention are going to start scratching your head and say, wait a minute, how have mortgage rates gone down that much when the 10-year Treasury yield has continued to go up? More on that in step number 2. The next chart I'd like to point out is one that might give us a glimpse as to what supply may be in 2021 or a little beyond. It starts in March of this year. These are the months, goes to December. On the left, goes from 1 million up to 5 million. These are the active mortgages that are currently in forbearance. So going back to March, that's when they started the CARES Act, where they had this program. It really shoots up almost 5 million and then comes down gradually. But again, just like the jobless claims, you can see here it's starting to flatten out and stay at an extremely high level, where the total of all mortgages in forbearance is up right around 5 million, and it's staying pretty consistent. This could present a huge problem for the supply side of housing, really putting downward pressure on prices when this forbearance program ends. And this data is backed up by Bloomberg, little different chart. Editor, let's throw it up. And we can see that the forbearance claims have actually spiked recently, and they're really flattening out. They're not going down significantly like we would expect, which makes a lot of sense when we see the damage that's been done to the job market and incomes. This is a chart that doesn't exist. It was only in my mind. I actually created this one, and it's to illustrate something very important when it comes to analyzing prices in the real estate market. And I think it's something that everybody misses. We understand the difference between nominal prices and real prices. Real prices are adjusted for inflation. That's what we want to pay attention to. Why? If we look at the home prices in Venezuela, denominated in their local currency, they have gone parabolic. But it doesn't mean that you have any more purchasing power by owning one of those properties. Most likely a lot less, for the simple fact that it's located in Venezuela. But why is inflation important? This is a question that most people really don't think through. So let's use an example of the government getting tax revenue. So we always hear that inflation helps the government because they are the largest debtor nation in history. Therefore, if they create inflation, that lowers their debt burden. But why does it lower their debt burden? That's my point. It lowers their debt burden because theoretically, tax receipts will increase to a level that makes it easier to pay down their debt. You see, if tax receipts don't go up, but inflation goes up, they're no better off. In fact, they're worse off because their expenses increase. And it's the exact same thing if we look at a real estate investor. This is something I think everyone can get their mind around. We always say, well, inflation helps a real estate investor because it reduces the value of the dollars their loan is denominated in. So, in other words, you pay back your loan with cheaper dollars. But why is that? It's because rents theoretically go up. If we have consumer price inflation and rents don't go up at all, technically, you're not paying that loan back with any cheaper dollars. The rents have to go up for inflation to be important. So going back to this chart of home prices adjusted for inflation, why does it make sense to use? Because one of the main factors in a house is the level of income. You got to have income to pay the mortgage, even if the interest rates are super low. And what we've seen in the past are wages stay pretty consistent with the rate of inflation. So assuming that wages are a constant, we can just look at home prices adjusted for inflation and determine whether or not it's cheap or expensive. But if wages weren't consistent, if they went up and down dramatically, like housing prices or stocks, then we would have to have a completely different chart. It would look like this. So the blue line represents home prices. The green line represents wages. So if wages are coming along, they're very flat, and this blue line goes up to an extreme like we saw in 2006, that would mean the prices of homes are extremely expensive. Why? Because the delta is so extreme. It isn't necessarily that prices went up. Here's an example. Prices can go up here, but wages go up even more to where the delta is smaller. Therefore, I would say that prices were cheaper than they were back here. Even if prices go down, if incomes go down even further, they could be more expensive because the gap between prices and wages has increased. So the prices could be more expensive here than they were right here, and they could be more expensive way down here than they were way up here because of the difference in wages. So my point is it's not just about housing prices adjusted for inflation. It's about housing prices adjusted for incomes. Because at the end of the day, you have to have income to buy the house and pay the mortgage in the first place. And for some reason, that's something that everybody misses. And it's crucially important you understand this dynamic so we can put all the pieces of the puzzle together in step number 3. Step number 2, mortgage rate deep dive. So many people come to me and say, George, I get it that the housing market is in a big bubble. Prices are at all-time highs, but it just doesn't matter because interest rates, mortgage rates are so low that it makes the monthly payment far more affordable. And I totally get it. That's a very good point. So let's examine mortgage rates in more detail so we can really get our head around all of the factors and cross currents at play. We'll start with a chart of the 30-year mortgage rate. I think we looked at this in step number 1. Go through it again. Starts in January all the way to January of this year, from 2% up to 3.5%. As you can probably assume, it's gone all the way down from 3.62% down to 2.68%. We understand that. The point in the chart I want to highlight is from August to January. Just a straight downward trend. Let's move over to this chart. This is the 10-year Treasury yield from January to December, or January 2021, about the exact same time frame. On the left, we go from 0.6%, 60 basis points, up to 1.6%. At the beginning of 2020, we were way up here at 1.6%. Woo! And it just crashes down with the cerveza sickness, kind of goes all over the place, very volatile, and kind of levels out around 70 basis points. Gets a little bit of a jump, But starting in August, the point that I wanted to highlight, it just goes straight up. Now, it's not going up much, especially when you look at it historically speaking. But today, we're up, last time I checked, over 1% on the 10-year Treasury yield. So look at this red line. It's going straight up since August. But this line goes straight down. So you start to scratch your head and you say, okay, well, if the 10-year Treasury is a proxy for interest rates in the real economy, how can mortgage rates be going down? And I know that they're not tied to the hip and sometimes they can go in different directions, but you've got to understand the concept. More on that in just a moment. One of the key takeaways for this step that I want you to start thinking through, because this goes back to step number 1, and this is something that very few people are talking about right now, even in the macro space. There is a risk premium, or there should be, on interest rates in the real economy. So even if the Fed is coming in and trying to execute on yield curve control, most of us know what that is. That's where the Fed is buying treasuries, monetizing the debt to keep those interest rates on T-bills, 10-year and 30-year treasuries down to where it doesn't really affect the overall economy. It doesn't leak into mortgage rates or credit cards or auto loans. The problem is this risk premium, the problem for the Fed. Because the market is going to look at future inflation expectations. And if future inflation expectations are extremely high, it doesn't matter where the Fed is pegging the yield curve, mortgage rates will go up to 8%, 9%, 10%. Who knows how high they'll get? Just to make sure we're on the same page, the Fed can come in and try to peg the 10-year Treasury yield at, let's say, 1%. But if the market, those entities out there creating the loans, have a high expectation for future inflation, mortgage rates could be at 9% or 10%. There could be a huge difference between the two because those lenders know they'll most likely be paid back with cheaper dollars. So this takes us to inflation expectations currently in the market. Editor, let's go ahead and throw up some charts of commodities. If we look at the price of oil in 2020, the price of wheat in 2020, or the price of copper, we see almost every commodity across the board has been going up. And rates on the 10-year Treasury have been going up, even though the Fed's balance sheet has been going parabolic. In other words, even though the Fed has been buying a lot of those treasuries, creating artificial demand, suppressing yields. So the market is telling us through price signals that it expects higher consumer price inflation in the future. But it goes back to this chart. If the market is seeing higher inflation coming down the road and there's a risk premium, why on earth are mortgage rates continuing to go down? I think you could probably guess. It goes back to the Fed's BS. If we look at the mortgage-backed securities the Fed is buying, same type of chart for the same time frame, 2020, the amount of mortgage-backed securities, or mortgage-backed sausages, as I like to call them, was actually going down. They were selling them going into the cerveza sickness. But then they reversed course and started buying as many as they possibly could, taking it up to 2 trillion. Let me go over this side of the chart here. I missed that. Starts at 1.2 trillion, goes up to 2.4 trillion. So beginning of 2020, they had about 1.6 trillion of mortgage-backed securities on their balance sheet. That goes down to the cerveza sickness, then goes straight up to about 2 trillion and has gradually been going higher and higher and higher. So what's going on is the Fed is coming in and taking away or reducing the risk premium because these lenders know, most likely, they can go ahead and flip that paper, they can flip that loan to the Fed, and they can still make money because they don't have to worry about being paid back with cheaper dollars. The Fed will worry about that because the loan itself is on the Fed's balance sheet, which, as we know, is infinite. They can take a haircut. They don't need to be paid back. They can be insolvent. It doesn't matter because they can just go to that computer and always print more bank reserves. So my whole point is if interest rates are going up, the price of copper is going up, the price of wheat is going up, the price of oil is going up. This is telling us that the market expects more inflation down the road. But if mortgage yields are going down, interest rates on a 30-year mortgage continue to go down, this means that the Fed intervention has to be a more powerful cross current than everything else that's going on in the market. So in the future, when we're trying to figure out if prices are going up or down in 2021, we have to understand we don't live or we don't have anything close to a free market in mortgage rates. And you're probably saying to yourself right now, well, George, duh, hello, I get it. But I really want to point that out with these charts in step number 2. So when we think about the probabilities of prices going up or down in 2021, we have to use some game theory and try to determine the impact that central planning, more and more and more central planning, will have to those prices in the future. Step number 3, headwinds and tailwinds for prices in 2021. And I'm going to give you my opinion whether we will see a boom or a bust. And probably the most important part of the entire video is this value bomb that I'm going to drop on everybody that's going to totally blow your mind. I guarantee it. But on the boom side of the equation, this would be the tailwinds. The bust would be the headwinds. We have supply. Very short supply right now. Definitely a tailwind for prices. But I would say that's actually a headwind as well. Why is that? Because the cure for high prices are high prices, meaning the higher the prices go, the more the builders are incentivized to create more and more supply. So this shortage of supply creates the incentive for more supply in the future. Low rates. We talked about mortgage rates being extremely low and backed up by the Fed buying those mortgage-backed securities. But I would say that same thing here. Low rates could be a headwind. Why is that? Because how far down can rates actually go? We're already at the zero bound. Are we going to get negative rates? And if we do, is the Fed going to be able to buy enough mortgage-backed securities in order to get the interest rates on those 30-year mortgages down even further than they already are? There's not much room to go down, but there's a lot of room to go back up. But I also want you to notice what I have in parentheses. CP, this is for central planning. See, most things on this side of the equation require central planning in order for them to come to fruition or in order to pull them off. On this side, it's all about the free market. So let's go back to the next tailwind, and that is everybody's favorites, stimmies. And if you didn't watch my video the other day, you gotta check that out. The stimulus checks, again, central planning, that's more money in people's pockets, could be a tailwind for prices. On the other side, we have the real economy. We're in a massive depression if you didn't have all of this deficit spending and stimulus checks. Household formation. They have really delayed, they meaning millennials and the younger generations, have really delayed forming households. So if that explodes in the future, I've read some articles suggesting it is. That means more demand for houses. But on the other side, we have to remember 52% of young adults 18 to 29 live at home with their parents, a staggering amount. And if you're living at home with your parents, watching or subscribing to OnlyFans, the chances are you're not going to be forming any households anytime soon. Next, we have forbearance, which also requires a lot of central planning and government intervention. The bottom line here is if you're not required to pay your mortgage, the chances are there's not going to be very many homes for sale. Tough to have prices go down. On the other side, though, we have stagnant or maybe even declining wages when you adjust for inflation. When we go back to step number 1, and wages is a part of this equation, just as big a part as interest rates. On that note, I want to look at a chart from Shadow Stats that shows the true unemployment rate, or at least the underemployment rate, that shows us there could be a lot of downward pressure on wages in the future. And let's not forget, without all the central planning and government and Fed intervention, the economy would be in a massive depression. Whenever I see the talking heads on Bloomberg or CNBC, they're always saying that the economy has been fantastic over the past 10 years. If that's so, then why have we needed 0% interest rates? Why have we needed QE infinity? Why has the Fed's balance sheet gone from $800 billion up to over $7 trillion if the US economy is so healthy? It's a rhetorical question. The bottom line is the US economy is just like a heroin addict in the sense that you have to give it more and more of the drug, more and more of the heroin just to keep it alive. And then we go back over to the boom side for everybody's favorite, money printing. Whether the Fed is increasing bank reserves and that's somehow getting out into M2 money supply by monetizing the government deficit, or if they just start doing straight MMT, UBI, stimulus infinity, where they turn those bank reserves into legal tender. The bottom line is if we get a lot of money printing, that can definitely drive prices a lot higher. So by looking at this boom bust, or the headwinds and the tailwinds, I think the conclusion that I want you to draw is if we have a boom in prices, that is predicated upon central planning. A bust would be if we allow free market capitalism to take over. So if you are bullish on housing prices in 2021, basically you're bullish on central planning. Let me say that another way. If you're long the housing market in 2021, you're long central planning, and you're short free market capitalism. Personally, I don't think that's a very good bet long term. So what do I think? What is my opinion on housing prices in 2021? Well, long term, let's start there. I think housing prices adjusted for inflation have to come down. We go back to that chart that I used in step number 1, or the chart going all the way back to 1900, I always use in my videos. And we can see that we are at a massively inflated rate today, just like we were in 2006. So at some point in time, we have to come back down to our historic trend line. We have to match up the prices with the incomes, just like we talked about in step number 1. But short term, over the next year, I think we could see both a boom and a bust. Let me explain. Let's go to another chart that really doesn't exist, and I just made this up. But this shows what prices could do in 2021. They could go up in nominal terms, but down in real terms when you adjust for inflation. In other words, your home price could go up by 10%, but if inflation goes up by 15%, you're actually losing purchasing power. Let me tell you a little story. The last time I spent a lot of time in the United States was in 2012 when I retired. I started buying a lot of real estate in Kansas City. Most of you know the story. But occasionally I would go to Chick-fil-A when I didn't have time for lunch. I'm not a big fast food guy, but I'd go through the drive-thru, I'd get a grilled chicken sandwich and one of those little cups of yogurt. I just went back to Chick-fil-A for the first time, now in 2020, went through Chick-fil-A, got the grilled chicken sandwich and the yogurt. The price of the meal was almost 14 bucks. I almost fell out of my car. I looked at the receipt because I thought they overcharged me. They didn't. That was the actual price. Just that little cup of yogurt increased in price to like $5.50 or almost $6. It completely blew my mind. What's my point? If you look at my real estate portfolio, most of those homes I purchased in 2012, I was all in for about $75,000. And those homes on average are worth about $150,000 or $160,000 today. So all of you watching this video would say, oh my gosh, George, that was an incredible investment. You knocked it out of the park. Your homes have appreciated in value tremendously. You're doing all right. But am I? Let's think about this. I can't buy any more Chick-fil-A today with those houses than I could back in 2012. Maybe even less. But I want to point out, even if you lose purchasing power on the real estate, in the example I just gave with Chick-fil-A, if you had a 30-year fixed rate mortgage, you would be making money on the debt because you'd be paying the debt back with cheaper inflated dollars, assuming those rents went up or assuming your income went up with the rate of inflation. So what's the main takeaway? What's the value bomb I was talking about? I really want you to make a shift in your thinking right now, here today. Before, in the good old days of free market capitalism, the property you purchased was an asset on your balance sheet, and the debt, the mortgage, was a liability. But now, as crazy as it sounds, with all of this central planning and this upside down world, I think the balance sheet of the average Joe has shifted. Again, before, the house was the asset, the debt was the liability. Now, I think the debt could actually be the asset and the property itself the liability. So I think that nominal prices for housing in 2021 maybe stay flat, go up a little bit, maybe down a little bit. Not too much of a change because real estate takes a long time for it to change direction. Just like we saw in 2006, it took 6 years to drop by 50% and find the eventual bottom, which was the historic trend line. But let me be clear, my opinion on prices in 2021 really doesn't matter that much. What you should be most concerned with is really changing your thinking, understanding that in the future, probably gonna have a lot of money printing, a lot of central planning. The market is seeing higher inflation expectations. So you look at your balance sheet, if you do own real estate, instead of seeing it as an asset, now I might even see it as a liability. But that debt, that 30-year mortgage, you know what you're doing, that's gonna be your asset long term. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.